Tech stocks got crushed in 2022. Google's parent company Alphabet is down about 40% over the year. Netflix is down about 50% in the year. Peloton is down about 70%. And then you have Carvana, which is down over 96% on the year. In 2022, investors lost over $3 trillion in the tech sector alone. That's more than the total GDP of Italy, Denmark, and Ireland combined. This has a lot of people wondering if we are seeing a repeat of the 2000 dot-com bubble bursting today, where in the mid-1990s we saw a huge influx of cash into these internet companies because interest rates were cut low in the mid-1990s, and all this cash into the internet companies caused this huge internet bubble to get created and boom until ultimately 2000, 2001, when the money stopped flowing in and then the bubble burst. Like you might remember the popular Pets.com and Boo.com. Oh, you don't remember these companies? Well, that's probably because these companies, along with dozens of other big internet companies, were forced to shut down when the dot-com bubble burst. Even strong companies were hit hard, like Amazon stock fell by more than 90% when the dot-com bubble burst. But the internet companies that survived were able to thrive, and it made the investors who bought the dip very, very rich. From the dot-com bust to 10 years later, IBM saw their stock grow by around 300%. eBay saw their stock grow by around 400%. And Amazon saw their stock grow by around 2,000%. So the investors that saw this dot-com bust as an opportunity were able to make some great returns, assuming you made some good investments. This is why I keep saying that market crashes and recessions make more millionaires than any other time, because during the dot-com bust, we saw the market crash. We saw some bad companies get shut down and go bankrupt, and then we saw good companies get hurt because of everything else going on in the economy, and this created an opportunity for then investors to come in, buy these assets at a discounted price, and then they were able to ride up the wave and get rich, while other investors lost everything. So the question is, how do you find a good investment like the next Amazon, and how do you actually capitalize on it? Well, the first thing is you have to understand the environment that we're in right now, because the reason why you're seeing a lot of comparisons to the dot-com bust and this tech bubble bursting is because we are in this tech bubble bursting phase. We have seen tech companies get obliterated in 2022, and part of the reason for that, just like the dot-com bust, is because interest rates have been skyrocketing in 2022 after we saw a long period of very low interest rates. So after the 2008 crash, interest rates were cut to zero, and they essentially stayed near zero for most of the last decade and a half, and these low interest rates created an environment where you could see a big boom in tech companies because lots of money in the form of debt and venture capital went into these tech companies, which boosted valuations, which caused more money to go into these tech companies, which created a big boom. And now the interest rates have risen so much, the venture capital firms and the banks and the investors are saying, we don't want to keep putting our money into an unprofitable investment. We want a more stable investment. So we need tech companies that are more stable. And many tech companies are saying, wait, what do you mean profits? We're not ready to make profits yet. So these quick interest rate hikes created a big shock in the tech sector because now tech companies weren't able to go out and get capital the way that they could have before. Before, a tech company could say, look, we increased the amount of users we had, we increased the amount of followers or subscribers or whatever we had, and now because we have 20% more subscribers, we need another $200 million. That way we can continue growing a subscriber base. But now because the money is drying up due to higher interest rates, tech companies can't keep getting more money, which has been causing tech companies across the board to get hurt, which is why so many tech investors have lost money in 2022. Now, we've been covering what's happening in the tech sector pretty in depth on Market Briefs, which is my free financial newsletter. So if you haven't joined Market Briefs yet and you're an investor and you want to understand what's happening in the financial markets, you should join Market Briefs because it's an easy way for you to stay up to date on what's happening in the financial markets, when it's happening, and it doesn't take that much time either. Like, you can read Market Briefs in less than 5 minutes every morning, and it's completely free. So if you haven't joined Market Briefs yet, I'll put the link to how you can join down in the description below. This is where you're going to have to understand a few things. First, on the topic of interest rates. High interest rates are going to hurt the tech sector, and as the Federal Reserve Bank continues to raise interest rates, it's going to continue hurting the tech sector even more because you're going to see more and more companies struggle to get access to more cash, and if a company is not profitable, well, they're going to really be struggling. So that's the first thing that you have to understand. Second is that the tech sector isn't going away. Technology isn't going to be disappear tomorrow, just like how the internet sector didn't completely disappear after the dot-com bubble bursting. We saw internet companies die, but the internet stayed alive. And the internet is thriving more today than it was 20 years ago. So what does that mean? Well, if you apply that similar logic to this tech sector, technology will still be here in 20 years. Will the same companies today be around in 20 years? No. Some companies will go bust, some companies will go under, and some good companies will get hurt very bad because of this tech bubble bursting. So what does that mean for you? Well, that means that you could potentially find great opportunities in the tech sector if you can find a good company that's hit hard, not because this company's on the verge of bankruptcy, but because of everything else going on in the tech sector. Unfortunately, there's no easy way to find the next Amazon. And people spend a lot of time, effort, energy, and money researching companies. And you could potentially go out and research companies to find the next investment that you want to make, or you can also consider investing in an ETF. If you don't want to spend all the time, effort, energy, and potentially money to find the best company, well then the next best thing is you can look into a tech ETF that gives you exposure to companies and buy some of these ETFs, especially when the tech sector is getting hit hard. Now, what you also have to understand is you're not going to be able to perfectly time the bottom, because a lot of people are saying, I want to buy in exactly at the bottom and then I'm going to ride the wave upward. Well, it's not so easy, because nobody knows when the bottom is going to be. Is the bottom going to be now, or is it going to be 50% lower than where we are now? Is it going to be 90% lower than where we are now? Is it going to be 2% lower than where we are now, or did we already hit the bottom? It's impossible to know that. And this is where you have to also know now, not just what you're going to be investing in, but your investing strategy. Are you investing money once? Are you investing money every week? Are you investing money when you see a big dip? And so you have to know how you're investing. Dollar cost averaging, again, is more of a passive way where now you can set up a system where every week or every 2 weeks you're investing your money into the market. Now, if you're just getting started as an investor, you want to start by understanding the different types of places where you can invest, understanding how you can invest in the S&P 500, how you can invest in a specific sector like technology. Don't just throw your money into one company or to one sector because you think that's the best opportunity. Yeah, the tech sector is getting hit hard, and that is going to create a lot of opportunities, but you have to be more educated and understand where the opportunities are. But the thing that makes this economic slowdown and this tech slowdown so unique and very different than the dot-com bubble bursting is the patience that you're going to have here, because unlike the dot-com burst, where the Fed was able to start stimulating and inflating the economy, they didn't worry about inflation prior to the 2000 dot-com bubble bursting because inflation wasn't a problem. But today, inflation is a problem. So it's much more difficult for the Fed to start stimulating and inflating our economy today. That means that you're going to have to be even more patient in this economy, in this economic slowdown, in this asset cycle slowdown before the Fed could start stimulating, which means that you're going to have to be a more patient investor and a more diligent investor. And that means we could potentially see even more pain now. We've seen a lot of pain in the tech sector. We've seen some companies go near bankruptcy. We've seen some companies declare bankruptcy. But this is where you have to understand that the pain is not over. It's going to spill into 2023. And this is where you have to be paying attention to what's happening in the markets, pay attention to what's happening with the Federal Reserve Bank, and pay attention to what's happening with inflation and the economy, because all these three things are going to be coming together to help impact what's going to happen in the future for your money. Market crashes and recessions cause some people to lose money, but it also creates opportunities for people who think a little bit different to then take these opportunities and buy the assets at a discounted price. And this is where you got to understand not just to be scared of what's happening, but look for the opportunities. That way you can be one of the people that benefit from the way that the system works. You know what? People listen to what I have to say now. Why? Because I got money.
Right,
it is what it is.
Yes.
It's a gravity.
There's some credibility to it too, It builds credibility, authority, trust, all these different things.
And I hope that, through my genuineness, I've been able to build that.
Yeah, man.
But, I talk about the system like gravity.
Yes.
It is what it is. You can fight it or you can understand it. Learn the rules to the game.
And leverage it.
Learn the rules to money. Leverage it. Use it to your advantage.